Good morning and welcome to the Pureprofile Q1 FY24 financial update. My name is George Copsey-Aftis. I'm your host today. With us today we have Martin Fields, the CEO. Morning, Martin.
Morning, George.
Mel Shepherd, the CFO. Morning, Mel.
Good morning, George.
And we've got the pleasure of having our chair today, Linda Jenkinson. Morning, Linda.
Morning, George.
The format for today will be Martin and Mel will present the results. It should take around 10 minutes, and then we'll move to a Q&A session. Linda's made herself available to answer any questions you may have today. For anyone that'd like to ask a question, please click on the Q&A ribbon below, and I'll be asking all questions. If there's a number of questions that are similar, I'll try and aggregate them and just ask them the once. With that, I'll hand it over to Martin and Mel to start the presentation.
Brilliant, George. Thank you very much. And thank you very much for everybody who's joined this morning. So to start off with, I'm really delighted to have not just another growth quarter on revenue and EBITDA for Pureprofile, which we've had, I think, every quarter for the last 3 years. But actually, again, as we've had a couple of times, to have a record quarterly revenue of 12.3 million and record quarterly EBITDA of 1.5 million for our continuing business. So absolutely delighted, and thank you obviously to our amazing teams and clients and partners that we work with. A bit of detail in this. So we've seen our 16% growth in revenue. We've got 36% growth in EBITDA, so seeing that margin expansion coming through of processes, scale that we're now seeing as of the business, as well as we talked before about some technical developments that we've done that are adding to that expansion. And that's then come out at 12%, up from 12% EBITDA margin, up from 10%. So delighted on all of that. Growing our client base, so 809 clients, up from 760. So again, seeing that we're winning more clients as well as keeping our own, and that's coming down to, again, especially in our space, a lot of people are talking about quality of data, quality of panelists, and then quality of people, and obviously we have quality in spades. So we're winning market share from competitors and growing those clients because we're absolutely delivering time after time. Platform growth, to see that at 118%. Again, that's driving some of the margin expansion that we see, and that's coming from growing those partnerships within Audience Builder. And we talked at the end of the full year, bringing on board Shopback and Student Edge as two that are contributing to that, as well as continuing growing of Flybys. And then that's coming from, again, 12% uplift in project volumes across particularly end clients rather than just research agencies. So that's great to see. And so the detail per region, we've got 6% growth in ANZ, where we're absolutely the market leader in the space and still seeing growth there in from our clients and winning competitor shares. In the rest of the world, that's up 34%. And again, I've said that before, but we made that particular investment in Q4 financial year 22, and that starts to ramp up. And we've seen that growth double. Rest of the world was growing last year, and we've seen that growth coming on board. And again, that investment that we made, now winning more clients with those clients that we won last year, seeing an increase in the share of wallet from those clients. And then finally, platform up to 118% growth, 1.8 million. And that's from, again, growing existing partners such as Flybys and bringing on those new ones again. So a really strong quarter for us, and seeing the growth exactly where we've been making that investment. So I touched on a number of these points just now, but the new salespeople that we added in Indonesia, Singapore, and the UK, feeding that rest of the world growth. continuing to win market share from competitors because the quality challenge they've got. We don't have that because of our partnerships that we work on and a number of other initiatives across our panelists. And the supporting growth through the presence that for the first time we started to run those last year, and that was actually international conferences. And we haven't had stalls, booths, presentations before, and that's now starting. Now we've run one in the US, couple in the UK, one in mainland Europe, as well as the normal ones we run in Australia, and we haven't done that before. And again, immediately bringing through return on investment and wins for us. Audience builder, adding panelists through major partnerships continues to be an absolute strategy for ourselves. We've now had a full quarter of Shopback, the cash rewards platform that came online at the end of last year. So that full quarter in Australia has now added to that revenue. Another one, as I said, was Student Edge. We've now got a full quarter of Student Edge, bringing on a ever important younger audience for us. We've invested in our first audience builder salesperson. They've joined in the UK. Sam has only just joined into her second month now. And so we will hopefully start to see a pipeline coming through of UK audience builder partners, as we've seen in Australia. And all of that has led to growing the 118% for the platform. Technology launches that we've seen, AI translations is now live. So that's instead of going to a translation agency, we now do all of that through AI, delivering to clients projects in hours instead of in days. So that's increasing our capacity internally, delighting clients that we're turning around projects much faster. Fine-tuning all of our platform survey delivery, where we're now direct to clients, and we've got a number of clients, and again helping that EBITDA margin expansion. We've got a number of clients directly accessing our panel instead of needing to go through salespeople or operation people. And then overall other system development. So absolutely, now we've talked about being through stage 1, stage 2. We're now into the innovation stage, where initially for this half targeting internal efficiencies, and we've got 3 major developments in half 1 that will again deliver to clients faster, increase our capacity, and continue to increase our margins. So really 100% chuffed with how the whole business is progressing. Now I'm going to hand over to Martin.
Hi, thanks so much, Martin. So as Martin, when he went through the lovely summary slide of how we performed for the quarter, had detailed, is that we had a record quarter from a dollar perspective of $12.3 million, which is fantastic. And we had 16% growth year on year for the quarter. And you can see here the strong growth that we had in the prior 2 years. If I look at how we performed in Q4 last financial year, and we did indicate to you there has been a bit of a softening, particularly in the UK. The quarter growth for Q4 last year was 14%. So, you know, and we did indicate that we're starting to see some green shoots. And for example, the UK, we're starting to see more projects coming through. And so that really validates what we had told the market back in when we put out our full year results, that we're starting to see that growth pick up a little bit again, off the back of much stronger growth in prior years from that perspective. So where did this growth come from? So we had really fantastic, strong growth in our end brands. So that's where we're working directly with clients versus working via research agencies. Interestingly, we've seen quite a bit of work during the quarter from media agencies, which is really just a function of the fact that, you know, a lot of companies are making sure that when they are going to spend money on marketing dollars, that they're making sure that those ads that they're putting out are effective. So we thought that was a really interesting point to note to you. Multi-country studies are really important. It's one of the things that we're really focused on doing. So that's where we're working with more global clients, where they're doing studies across multiple countries rather than just doing studies in Australia. And then another interesting data point, that the rest of the world revenue was really boosted by 3 key markets, so Singapore, India, and Europe during the quarter. And then obviously you can see from the platform revenue growth that was really strong of 118% for the quarter, that's really off the back of those audience builder partnerships with some of the new ones that are sort of starting to get quite a lot of traction. But we're also seeing still solid growth within our Flybuys partnership. So that's really fantastic. And that we're continuing to grow our client base up to 809 clients had commissioned work with us over the last 12 months. And that's been up from 760 on the prior comparable period. So fantastic results from a revenue perspective, which we're really proud of. If you go to the next slide, please. And then 36% growth in continuing business EBITDA. If you're interested in looking at what the EBITDA is or any of the other financial results compared to the reported business for FY23, there's an appendix at the very back. That's where we've included the impact of the Pure Amplified business in last financial year. But this is purely continuing business, so everything that we have today for a like perspective. If we look at how we went in Q4 last financial year, the EBITDA growth was 30%. And as Martin said when he went through the first slide, we are seeing both gross margin and EBITDA margin expansion from all the investments that we've made previously from that perspective. So quarterly EBITDA was 1.5 million, which obviously, as you can see, is a significant improvement on the prior comparable periods. Platform revenue growth has really helped bolster that EBITDA. And then the final point that I wanted to talk a little bit about, because I know that it's a significant change sort of in the way that we classify things, is the shift in our short-term incentives are moving from equity-based to cash-based. That has only just been finalised. So there is no provision in the accounts in the first quarter of this financial year for that STI. The STI provision we're expecting at this point in time in the financial year for the full year will be $1 million or just over that. There is no LTI program in FY24 as well. Typically the equity, when the incentives have been given to the key management personnel and the executives as equity, it falls under share-based payments, and that's not included in EBITDA. We would consider that a significant item and pull that out. So I just want to be really clear that there will be a change, obviously, to our margin if you look at it year on year, because in FY23, there was no short-term incentives that were paid in cash and then will fall under an operating expense. So, and we will not consider the STI provision either a significant item. So it will be included in EBITDA in prior quarters. That provision will be started to be taken up in our accounts from the 1st of October. One final thing before I go into the other slides, I just wanted to update everyone on. I'm sure everyone's interested to find out how our refinancing is going. We are in the very final stages of completing all the legal documents with the new provider for us. We are hoping that we'll be able to notify the market once all those documents are signed, hopefully prior to the AGM. We're in the very, very pointy end at the moment. We have no plans to do any capital raising at this point in time, and we are very confident that the refinancing will be finalised very shortly. If you go to the next slide, please, Martin. So just a couple of slides showing our trends and the business momentum, very consistent with what you've seen over the last probably 3 years, continued growth. We've put in there the 3-year compound annual growth for each of the different revenue streams and EBITDA. So I won't spend too much time going through this, but just as we said, consistent with what you've seen over the last couple of years. And then the next slide is back to Martin. That's me done.
That's brilliant, Mel. Thank you very much. Just to add 2 things to the points Mel made, I think, and something I forgot at the beginning. Rest of the world now makes up 73% in Q1 of our global revenue, and this time last year only made up 58% of our revenue. So we can see again that investment paying off. And whilst Mel did point out the STI makes a difference to our EBITDA, we've actually again posted online. You can see the messaging on there that it actually also makes a material positive difference to our NPAT. So we're very excited about that as well. So International expansion, especially in the UK and US, that's absolutely what we're seeing. And as I said, UK, US, that's where we're putting the investment, is English language, same as in Australia. Obviously, it's easier for us to roll out new clients, lower cost of winning new clients and lower cost of maintaining those clients as well. And those are particularly two big markets. As I said, UK 14 times bigger than Australia, US 40 times bigger. Audience Builder, continue to see new additional partners. And we talked about hiring Sam in the UK to drive the UK Audience Builder partners. And then those technology improvements. It's all around delivering more efficiently the work, growing the margins, and then being more innovative within our client delivery as well, and embedding where we can generative AI into everything that we do today. It's making development work much faster, much easier, and more impactful as well. So in summary, international business growth, way more than double. We've talked about double before, and it's nearly 5 times, more than 5 times ANZ. So fantastic to see that. Record quarterly revenue and EBITDA across the organization. EBITDA margin in Q1 growing to 12%. Continue to expand on clients and targeting those data and insights and audience builder opportunities. So the strategy remains in place, grow internationally, improve our technology, and focus on data and insights. So thank you everybody for listening. And with that, I will hand back to George for questions.
Right, thanks Martin, thanks Mel. Again, just to remind anyone that would like to ask a question, just click on the Q&A ribbon below and type your question in there and I'll ask it on your behalf. The first question, good top line momentum is nice to see. Now, can you please comment on the level of investments that's being made compared to the FY23 run rate in the business in relation to 1, product development, and 2, marketing?
I'm happy to answer that, George. I think the first point to make is the investment philosophy that Martin and I have had over the last couple of years remains unchanged. So our investment philosophy has really been to make the right level of investment to allow us to continue to grow from a top line perspective, but also allow us to move towards growth from an EBITDA margin expansion and also moving towards profitability. So that philosophy remains unchanged. With regards to what we're intending on doing this financial year, it's obviously following that philosophy. From a product development perspective, we're expecting to invest the same amount that we did this financial year, potentially slightly more, mostly just from a CPI perspective. The product development expenses, as many of you will know, is really people costs. So we capitalise the product development that we do. And so those individuals within that team, there will be we'll review their salary throughout the year from that perspective. From a people perspective, no significant investment. We have got some sales headcount in our plan moving forward, and that's really about continuing to bolster that top line revenue growth and obviously take us into 25 and continue that strong organic revenue growth that you're seeing now. Outside of that, there's not, as there has been in 23, not a lot of other significant investment into the business outside, things like marketing. Martin talked about some of the conferences that we've been attending. However, those conferences have quite a significant ROI on us, and the ones that we've recently done have actually contributed a lot from a lead generation perspective. So nothing different to what you're seeing now.
Great, thanks for that, Mel. Next question. How much total revenue can we expect from Shopback partnership when mature? And is the Asian parent launched in their key audiences yet and making material contributions?
Yeah, thanks, George, for your question. So Shopback, we don't give specific numbers. They give competitive intelligence as well, but we expect Shopback to easily be our second largest partnership behind Flybuys. So very excited about that. And in actual fact, we just literally last week soft launched in one of their other markets, which was Singapore as well. We don't know until we've launched. We don't know if that would be as successful as we're seeing in Australia, but we'll see those numbers, if they do come through, start to come through in Q2.
Thanks, Martin. Next question's around the STI announcement this morning. I'm not sure who'd like to answer this one, but the question is, what are the STI metrics?
I'm happy to take that, George. We won't disclose the specific STI metrics. We'll discuss it in the remuneration report because it is sensitive. However, we do have financial measures as well as non-financial measures, as well as financial gateways. So it is traditionally structured, and we would discuss that in the FY24 remuneration report in more detail.
Great, thanks, Linda. And Linda, while we've got you there, there's another question specifically directed at you. You've been with the business around 6 months. What's your focus been?
So the focus that I've had since I've come on board is the majority of the board are new. So basically really getting the board oriented to the company. We can see that the executive team is doing an excellent job of running and managing the business, and it's really setting in place our go-forward governance process and procedures. Secondly, you will have all noticed the announcement of Mark Healy joining the board. So we did a skills review in terms of what was wanted and needed, and we're delighted to bring Mark on board. And then we've been working through our revised remuneration framework, which we announced the STI element of today. They've been the main focus since I joined, George.
Sorry about that. Thank you, Linda. Question here, probably for Mel. How much can EBITDA margin improve as a result of internal developments?
Yeah, so we've obviously experienced EBITDA margin growth over the last couple of years, and we are obviously committed to continue to grow that margin expansion. I know there's a question there just talking about some of the AI enhancements that we're making and how does that improve margin. So maybe giving an example of that's probably a great way to kind of illustrate it. So Martin talked about language translations being one of the key AI initiatives, or the first one that we're rolling out. So previously we would have outsourced that to a third party, and that's where a client comes to us and we've got to conduct a survey in a non-English country. So we need to speak to panelists that don't speak English and then convert the responses back in English. So we would normally send that externally. We will no longer need to do that. And that also then would also result in us taking a lot of time to go back to a third party to do that from that perspective. So some of these initiatives not only improve the margin from the perspective we don't have to pay a third party to help us perform those services. Some of the other initiatives that we do mean that as we continue to grow our top line revenue growth, we don't need to use as many operational team staff to support that. So a lot of what we are doing from a technology perspective is really around internal efficiencies rather than specifically growing the top line. It's about making us more efficient so that we can move towards continuing that EBITDA margin expansion. So when we look at what we're going to develop, we're looking at, okay, what's the return on that investment? How does that allow us to get margin expansion moving forward? And then how do we also deliver more quickly and to a higher standard for our clients? So it's kind of a combination of all of those things.
Great, thanks, Mel. There's a few questions here on rest of the world, so I'll just try and aggregate into one question. Basically saying rest of the world's performing very strongly. Before too long, it'll be a very big contributor, well ahead of the legacy businesses. Can you provide some insights into individual country profitability and recognizing that there's commercial sensitivities and confidentialities?
Yeah, good question. So latter first, all of our countries are profitable, and typically within around, we've talked about this before. So when we open up a new market and we add commercial people, those commercial people are then supported by their local hub. So for example, we just opened up Indonesia. They're then supported by Singapore. Singapore in turn is supported by Australia, and then supported by India and the Philippines in our offshore centers. So we don't, when we open up a new market, we don't add costs. We actually do it very leanly in new markets. So clearly UK is our largest market today. We have about 15 people in the UK today, and that's where we've seen the strongest growth. I saw we also had a question about when will it overtake Australia, the rest of the world. It's sort of run rate wise towards the end of beginning of 25. If it carries on at this growth rate that we've seen, then we would see it grow in those other, the rest of the world would be larger in 25 than it is than Australia.
Thanks, Martin. Next question. Can you provide an example of how you use generative AI and how it leads to margin expansion?
I think Mel just did that with the translation tool.
Yeah,
so
I think
we
you're
used
right.
to go to translation agency, you spend $100,000, don't have to anymore. I saw another one actually, George, just to say another comment, which is around the STI payment and why it was previously excluded from EBITDA. And I don't think we covered this on this call, but it is in the release. They were share-based payments before, so they sat beneath EBITDA. It had the same effect on NPAT, and we've now, because we're in a stronger position, we're able to reduce that from being beneath the line, reduce dilution, and actually pay those out in cash. So if it was like for like, it would be a net. And again, if you see in the release, they've actually also been reduced. We have no LTI for this year, and we have reduced payments on the STI. So actually, we've said that's a material positive impact to our NPAT for financial year 24. So if people are unsure. And then I saw another one from Mike Hale, and we've been operating cash flow positive for nearly 3 years now.
Can I just add one point to the share-based payments, just for clarity as well? So whilst there's no plan for employees for FY24, there are still plans that are running through. For example, FY21 and FY22 and FY23, long-term incentives vest over 3 years. So the accounting treatment is that you expense it from grant date to final vesting date. So you will still see share-based payments when we put out the half-year results, and the full-year results, they will be at a significantly lower quantum, as we have said previously on the call, but there will still be some plans being expensed through our P&L for the rest of this year and then moving into next year as well. And that's predominantly because those incentives are long-term incentives and they vest over 3 years.
Another one that I just saw to add to that, Mel, is investment-wise. So our growth is absolutely growth within our very considered investment that we have at the moment. Mel, I don't know if you want to mention that. I saw a question that asked, is our investment going up or has it increased with the results that we've had?
We're obviously continuing to invest because we can't sort of grow at that top line perspective of 16% without investment. We require headcount resourcing to do that, but we are not investing to the same extent as the revenue growth, if that makes sense. Excluding the fact that we will have higher cost from an STI going into the P&L impacting EBITDA.
Great, thanks, Mel. There's a couple of questions around the partnerships, particularly in the US and UK, and how, if where they're at, how they're progressing, and if you expect positive material impacts in revenue in FY24.
Yeah, so as I said, with Sam joining in the UK, building up a pipeline now of audience builder clients, typically it takes sort of 6+ months to close a large deal. So if there is any impact from any that aren't in the pipeline today in the UK, then I'd expect that to start in Q4 of this year, and then we would see some in 25. But as I said, we don't have any at the moment. And in the US, we're still working through a couple, and again, we're now into second quarter of the year, so I wouldn't expect any impact of anything in the US to happen until again Q4, if any of the few that we're working on at the moment move to fruition.
Great, thanks, Martin. Question for Linda. My sense is that the M&A animal spirits are starting to awaken after a bit of a hiatus over the past 12 to 18 months. Has the board taken advice on and/or discussed takeover defence strategy?
Basically, with the depressed stock price, I think every board has a discussion on this issue, and we certainly have discussed our approach to that. So we're taking that as a serious possibility, as any board would.
Thank you, Linda. Another question specifically on India. Is there a single client, or are you gaining traction there?
I don't think we talked about that. Funnily enough, we are gaining traction in there. So we have a couple of sales guys. India, we have about 100 people in our offshoring centre in India. We have about 15 or so now in the Philippines. But we've also added a couple of salespeople. So it's not just an operational hub for us. And yes, we are seeing good growth across India. It's a lower priced market, so it's higher volume at a lower price, and you've just got to bear that in mind. So adding projects into the system, and then not as potentially as EBITDA margin. The gross margin is good, but it's not as EBITDA margin because you need more operation people. So yes, we're cherry picking what clients we work with in India, and yes, we happen to be seeing good growth in India. So I don't know if that was one of the salespeople in India that asked that question. So shout out to them. Good job.
All right, I'm just conscious of the time. We're running a little over. I might just make this the last question. Great results. Well done to the team. It seems like the value of the business is not reflected in the share price. Do you have a view about the share price and what can be done to help the market recognise PPL's value?
Yeah, look, I think it's multiple strategies. So number one, we have a fantastic IR company in the IR department to ensure that we meet with existing funds, continually meet with new funds, conduct speaking engagements, make sure our messaging is to point around shareholders. That's a market that's very different to messaging around our B2B side. We are, I'd say, for about the last year or so, we've certainly upped our contacts and our marketing across retail investors, whilst we've seen funds to investing less across micro caps. We've actually increased the number of retail investment engagements that we do, podcasts I talk on, etc., about the company. It's also to keep doing absolutely what we're doing at the moment. We've heard from the markets that the key is to keep going as a growth company, which we're demonstrating, to head towards profitability. And we've talked about that in the last, at least the last 2 quarters presentations. So that's absolutely a focus. And to keep growing internationally. So we've got that story about being an Australian public company that's doing well in the rest of the market, and to make sure you don't make any knee-jerk reactions with a low share price, hoping that you see something that will change the course of the share price, but actually do what you say you're doing on the tin keep delivering great results. And the markets, when they come back again and investment comes back into microcap, then Pureprofile will be seen, as it is by many today, as great value.
Thanks, Martin. They almost sounded like closing remarks. I don't know if there's any more for you to add there. Linda, would you like to make any closing remarks before we end the session?
No, I just think I'd like to emphasize, the incredible work that the team is doing in terms of the consistency of the results, with the headwinds that are out in the market, and just congratulate them for their hard work.
Great. Thank you. Thank you all for today, and thank you for everyone who's listening in. That concludes the webinar for today.